And then so there's this huge misconception that security tokens were illegal. You do not need new regulations for security tokens. Why? Because securities regulations exist, and securities regulations do not reference paper, right?
Yeah,
Anywhere
exactly.
They don't say when you sell real estate to someone written on a piece of paper. It just says when you sell real estate to someone, or when you custodize real estate, or when you trade real estate. It never says on paper.
Welcome to another episode of the Untangling Web3 podcast. Today, we're honored to have Julian Kwan, co-founder of 8 companies across social media, real estate, prop tech, and blockchain. He is focused on building key infrastructure connecting DeFi and TradFi. Julian is the co-founder and CEO of InvestorX, the leading tokenization SaaS platform in Asia, and IXSwap, which is the first automated market maker for real-world asset and security token offerings. Julian is also the host of the Infinity and Beyond podcast. Welcome to the show, Julian.
Thanks, guys. I appreciate you having me on and getting up early.
Yeah, thanks, Julian. It's great to have you on. I'm really excited for this episode. So first things first, can you give us a real quick intro to yourself and your background, your career, and really what led you into the world of tokenization and Web3 now?
Sure. And thanks for joining everyone here in Untangling Web3 podcast. We kind of did the same thing on my own one, which is just trying to break it all down, explain it, clarify what's interesting, what's the opportunity, what's the challenges. There's a lot going on. So yeah, a quick background. I'm Sydney born and raised, and then Beijing and Shanghai for 13 years. I went to study some Chinese and then went back to Sydney and got bored in a week and went one way back to Shanghai and started a company that week. It ended up becoming very successful. It started as alternative advertising. We did the very first SMSs in the world when they were like text message, like buy a pizza with like maximum 10 characters or something. So right before smartphones, it's called Mailman, and ended up representing all the NBA and EPL social media channels in China, because it's a different world, right? You can't use Facebook. And I sold out of that, and we moved into real estate and did the first carbon neutral boutique hotel development in Asia and a bunch of co-working, and then real estate funds, but really wanted to get into the online space. So about 8 or 9 years ago, I moved to Singapore because I wanted to stay in Asia and develop one of the first online investment platforms. And that was the first iteration, I guess, of InvestorX, which began as InvestorCrowd. And it was modeled off the very first US real estate crowdfunding platforms. So we set that up, and we put money into about 30 different private equity real estate deals, and got a license off one of the first online investment licenses. Singapore was very pro fintech, and Hong Kong was very anti. So that was kind of the choice for regulation. And so during that journey, realized that behind that first generation of platforms is quite low tech. So if you think about equity crowdfunding, P2P lending, those platforms, the first generations were very much a marketing machine. Yes, there were some great things. You'd look at deals, you could invest all over the line. It was online. You can invest all over the world. You could assess deals, but you actually signed a piece of paper, like once you wanted to do it. And typically, at least for real estate, sit on it and do nothing for 7 years, and we might get back to you. So we hadn't solved liquidity issues. We left a lot on the table. So 2017, 18, with the ICO boom, it was like, okay, this makes a lot of sense to me. We should use this to wrap real world assets. In a world of digital currencies, we should have a world of digital securities. And if they come together, we're going to have a whole new world of investment products. And that's going to be the biggest opportunity in finance. So what does that mean? We kind of embarked over the last 4.5, 5 years to stitch all the necessary infrastructure together to make kind of a one-stop shop where any investment firm could push a button and legally, compliantly issue, trade, custodize any type of security token, real world asset token. It's important and that's been the mission at InvestorX. And it's important as well that now we're using RWA, real world assets. That's like the 7th term that the industry's used since 2018. There were like ICOs that were then becoming STOs, then tokenized securities, and then security token offerings. And then we had, asset-backed tokens and now we're back to we're now at RWA, which is essentially the same thing. But what's really different now is that we used to get laughed out of all the crypto events because, if you're going to go build security tokens, you think, you need to go to blockchain events. And no one was talking about that. Everyone said, STOs are stupid and made no sense. But anyway, that's actually literally what happened. And now, like this week, I just saw the CEO of Franklin Templeton saying Bitcoin's a fantastic distraction from the biggest opportunity in finance, which is tokenizing securities. And it was like, yay. Larry Fink from BlackRock says the same thing. Yeah. Just found out he's on our newsletter. Actually, he subscribed by himself. So we've been shilling his name around because, one of the biggest firms out there. But for me, it was just very obvious. So, and then the next thing we did was we thought, okay, if you believe in a world of tokenized assets and there's a whole bucket here, right? Like there's the Bitcoins, the Ethereums, the alternative coins, the NFTs and DAOs, and then there's the security tokens, real world asset tokens. And if they're all issued on the same protocols, they're all living in the same universe, which is the whole point of doing this. But when we thought about it, we said, okay, actually, if you go back to 2018, everyone used to be saying, like, what's the point of this? Why tokenize any asset? It was like, liquidity for liquid assets. That was pretty much the only thing people said. The problem is there was no infrastructure to issue and trade them, and there was no market making. So therefore, there was no liquidity. So that problem was kicked down the road. And so by early 21, and it took us 4 years to get our security token exchange license in Singapore. So before we even had it, we were like, we've got to try to solve this problem ourselves because the crypto market makers are not licensed to market make security tokens, and the security market makers are trying to work out what blockchain is. They're all coming for the space, but that was the crux of the problem. One of the problems. That was crux of one of the problems. So anyway, so if you think about like a world of tokenized assets, it's like all the real estate, all the VCs, all the startups. You're not thinking about millions of assets, which there will be because we're going to be done with paper. That is the digital versus paper value proposition is the 101 of this whole thing. And in that world, then you think, well, most of these assets want trading, but they're not exchange traded products. So your $20,000 startup STOs, my, whatever it is, $100 million real estate fund, there's going to be too many assets. The top 1% will probably sit in security token exchanges with traditional market makers, just like the biggest startups get to go into NASDAQ and everyone else is trading OTC phone calls on paper. But so if you think about that, then you start thinking, all right, that is actually a bigger problem, like multiple times, 100 times bigger than the same problem that crypto had in 2017. So in 2017, I just give an extreme example because it's easier for people to understand. If you're a top 10 coin, you're on Coinbase and Binance, and you had lots of money and you paid $1 million to list, and market makers' life was amazing. If you were 10,000 altcoins, you sat on the DEX, the decentralized exchange, which actually is just a swap platform, and nothing was for sale, which is better than a paper version, which is impossible with ICOs. But the point is that there wasn't any liquidity. So 2018, the launch of what I still consider to be probably the best innovation in centralized finance was Uniswap, where they said, okay, smart contracts to crypto, anyone with a crypto, again, I'm simplifying it, can start a liquidity pool. And then when someone comes to the front of the DEX, we don't have an order book and matching engine because it's not a traditional market maker. It's a pool of value of coins and algorithmically driven. We're just going to give them a price, right? ABC token to USDC. Okay. Yeah. And anyone who has those coins can join the liquidity pool, share in the market making fees. But essentially anyone who has a coin can start the liquidity pool. That was the innovation. And then zero to hero on liquidity. And so we said, okay, well, could we build the Uniswap for security tokens? And what would that mean? Could anyone with a security token start a liquidity pool and fast and cheap, low cost? And what would that mean? And so what it meant was we'd fork the Uniswap code. We'd start with version 1. And by this stage, they're on version 3 because it started, 2-3 years before. Yeah. And so essentially what it does, how it operates, it's just like Uniswap, but behind the smart contracts, there's a security token broker and a security token custodian. So there's a legal pool and a legal trade. So that's the difference. Uniswap can't do security tokens because they don't have licenses. So then we sort of stitched all that kind of infrastructure together, and that's how we got to today, really.
Yeah, that's a fascinating story. Thanks for the history, because it sounds like you've been, in the weeds for a very, very long time. Yeah, I'm curious about how you're saying the difference between DeFi and Uniswap, and then what you guys are doing, is that you said you've had this infrastructure that sits below the smart contract. Is that like a centralized infrastructure that's run by you guys, and that's the requirement for the kind of regulatory side?
Yeah. So what we do is essentially very much, our industry. They come up with new terms every day, and it's confusing the audience. But essentially, we are more Web 2.5 because you do need, call it Web 2 securities, KYC, whatever it is, real estate funds, fund managers, like all that stuff is still there. But then Web 3 technology, blockchains and protocols. So we're issuing these assets on these protocols, which is why it sticks together. And you need to pass these securities through licensed entities that also have the technology. So that's why I say we're kind of 2.5, because we connect the dots. And what IXSwap is, it's essentially operates like a decentralized exchange, but there are certain parts of the transactions that need to go through these licensed entities. But we built it to have exactly, in brackets, as close to the UX UI that Uniswap has and the crypto has.
Okay.
So that's kind of how it operates. And as you guys know, there's been convergence as well, because the one thing that's, I think is really exciting, and we've been saying this for a long time. I think we did the first security token event in 2018 in Asia, and there was like 5 old guys turn up for free spring rolls, and they were like, this sounds great, It was like, all right. So let me break it down to why I think tokenization is so valuable and what's the real proposition here. Because most people are sitting here saying digital versus paper and blockchains are mutable and it's great. That's like 101, right? The second most important thing is that we're going to be, if you issue security tokens on public protocols, then you can plug into the power of decentralized finance and automated market making models. We built IXSwap to even prove that that's happened. So you can take your little startup share or whatever it is, and you can start a liquidity pool. Never happened before in the history of the universe. This is powerful, and it's powerful and it's magic. It's great. But there's like, if you issue tokenized securities versus paper securities, you have the ability to lend, borrow, and stake those assets. That's also something that's coming down the pipeline that's just beginning. This will be much bigger than the trading volume of security tokens. Because if I could take my VC fund token and go and lend it to you and get a yield on it, or vice versa, however it wants to work, versus I'm going to wait 18 years to get my exit from the VC fund, that's really, really powerful. And that's actually why JP Morgan's Onyx platform's tokenizing publicly traded assets, not because they don't trade, but because they're very hard to use in a lending and borrowing environment. So that's really powerful. And then you have new investment products. So the best analogy I like to give everyone is the ETF structure. So 1989, the first ETF, actually considered a failure, is a $6 million. And now the ETF industry is somewhere between $6 and $8 trillion. Like, it's massive, right? So in 25, 30 years, it's grown from nothing, again, zero to hero. But that was a new technology marrying with a marketplace. So now what we're saying is, here's the new technology, tokens, security tokens, real world assets, blockchain, marrying with the existing private markets, the trillions and trillions of dollars of that, then we're going to see an explosion of value, and we're going to see so you can create new investment products. So a new version of VC 2.0, I call it, or real estate 2.0, or tokenizing your ESOPs, which we've done so our team can trade. New investment structures will give us a whole new world of assets and a whole new way of investing into real estate, private equity, everything. That's massive just on its own. And then the last one I've got, and I'm not going to try and think of any more because these things are too kind of, the last one is new distribution channels. So if you try to sell a startup share, even a VC fund, which is probably more relevant to this world, into a private bank or a wealth manager or a money manager, like, there's no one's ever going to do it. Those worlds only invest, buy and sell assets for their captive investor base that are basically publicly traded, right? Digital, liquid, marketplace, compliance. They can get paid. They can screw a lot of their clients over by keeping them inside this loop, right? But anyway, the point is that they all started selling Bitcoin, Ethereum, and the next evolution's real world asset tokens, which is actually something they should understand a lot better, because we're not coming in saying Bitcoin is better than the US dollar. We're coming in and saying, here's this huge assets that you guys never sell because you can't get paid in the same format that you're used to using. And these guys pay way bigger margins because it's private assets. Give you an example of that. What can a private banker charge a client to trade a stock these days? Nothing, or maybe 1 basis point or 5 basis points. You can do it. We all do it ourselves on our phones. Like, what's the stockbroker do? Well, if I can go into a private bank and say, if you raise money for Jack's tokenized startup, he'll pay 500 basis points because that's what he pay, right? So now high private banks, 500 times the margins from a product. That's pretty exciting. But that's just that side. That's the TradFi side. On the other side, you have the DeFi side. So if FTX, Binance, Bitfinex, someone else, a year and a half ago or longer, they started launching security tokens in the form of tokenized stocks. They didn't do it properly because they didn't have licenses. They're doing all the stuff that we're doing. So they pulled them all down. But essentially, this is what platforms do. That's what banks do, right? They get a huge audience to start selling as many things as they can. So the Coinbases of this world now, and Coinbase is one of our investors, and we've just integrated with Coinbase Wallet and Base Protocol. The 15,000 institutions are asking for real-world asset services. We're going to be preferred partner in Asia. But the point is that Coinbase has 110 million retail wallets and 15,000 institutions. And they're selling crypto already, so they get it. And now what's next? The next evolution is trillions of dollars of assets. And it's the same for, you guys might not use this, but out here, the Southeast Asian version, there's one last example on this topic. The Southeast Asian version of Uber is called Grab. Grab. And Grab won the battle between Didi in China and Uber in Southeast Asia. Anyway, Grab's got something like 280 million wallets, right? And they first did Grab Finance, which was basically put the change from your cab fare into a interest, some kind of deposit thing. Now it's crypto they're adding, and then they add security tokens. And then you start seeing Grab Finance selling security tokens to 280 million people. So the distribution channels for this are dramatically changed, like worlds and worlds and worlds apart. And then Standard Chartered and DBS all launch crypto exchanges. And then the crypto guys are coming for it. So the TradFi and the DeFi guys are going to start competing much more closely. And that's great for security tokens, essentially.
Yeah. Thanks. That is extremely exciting. I really like how when you kind of gave credit to the idea of Web 2.5, and especially with these traditional kind of large entities, the idea of Web 3 might seem quite revolutionary and probably sometimes maybe a step too far, and you have to take these companies a longer journey. But kind of on that note, I want to ask, how would you distinguish between, say, traditional token systems and Web 3 tokenizations, and how do you kind of put that across to, say, the layman, which I imagine you have to interact with a lot in this kind of area, maybe?
I think so. What we spend all day trying to simplify, right? And it's like, okay, what's different now and why we're having this conversation is because I'll give the short history of the space because I think it paints a better picture. So in 2017, we had the first STOs. I think that the SEC in America was partly responsible for coining the term STO because they were like, hey, those ICO things are securities. They're not initial coin offerings. They're security coin offerings, but STO sounds better, And then people went, oh, STOs are illegal. The SEC is fining people. And they were like, no. The ICO, the initial coin offering, was considered a security by all its features. And we're going to fine you because you didn't follow the rules like everyone else has to. And then so there's this huge misconception that security tokens were illegal. You do not need new regulations for security tokens. Why? Because securities regulations exist, and securities regulations do not reference paper, right?
Yeah,
Anywhere
exactly.
They don't say when you sell real estate to someone written on a piece of paper. It just says when you sell real estate to someone, or when you custodize real estate, or when you trade real estate. It never says on paper. So that was mad confusion. And at the same time, of course, you had, the actual cryptocurrency, so not security tokens, growing across the world, and also mad confusion in every single country. What is it and what's the regulation and how it works? So in 2018, we had kind of the birth of these STOs. And I use STO. I don't use RWA. It's just harder to say, but it's the same thing. Real world asset tokens, security tokens. Then you had the first infrastructure companies that could help people tokenize assets. And what did they do? They were just tech companies. They promoted all the value of what we're talking about here, but they couldn't do any of it except the token issuance part, because raising money, trading, custody, AMMs, etc. That's all regulated activities. It has securities licenses around them. But that's where it began, because that was the easiest thing to do. All the venture capital guys piled in, thinking this is going to be the next crypto, whatever they thought. And then the actual volume went down in 2019 because more and more of the issuers realized that, okay, so, pay this money in tokenized. So where's the exchange and where's the trading and it's like, oh yeah, we don't really do any of that. So it used to frustrate the hell out of me. But anyway, that's what happened. And then in 2019-20, you had the first security token exchanges. So that was T0 in the US, the Singapore long-term kind of ADDX. They're necessary infrastructure for the greater good of the industry, but they also very limited on value proposition because they didn't help on the primary issuance. So they're waiting for fully funded security tokens to fall out of the sky that are apparently on the right protocol rails. And a lot of these guys did private chains, and everything we talk about in this podcast is not possible on a private blockchain. Everything I'm talking about today is on public blockchains. And so there was no market makers because they needed market makers with licenses who'd go onto the regulated market making security tokens. How do we go? So, and here's the fee structure, and so people were like, well, tokenizing private assets kind of looks and feels like publicly traded assets. And when we list on NASDAQ, that's great, right? And $100 million of fees, but there's all this money around. And in a new world, in a new industry, there's all this money's not around. So the structure is out of whack.
That's interesting. So you had like the crypto Wild West, but there was no one really willing to try and solve the whole problem for security tokens offerings, right? And
well, there were people working on it, but it was like in 2018, we had the broker and we were trying to build the token issuance and then trying to work out, what's legal, what's not, all that kind of thing, how's it going to work. And then you started getting more infrastructure. So then along came the security token exchanges, but their model is challenged. Then you started having more security token issuance companies that had a broker dealer license. Could then start to actually legally launch them and raise capital. So that started going on in 2021, 22. And then now, around the world, there's a lot more players that have spent, so the industry is only 4 or 5 years old, but in the last couple of years, a lot of people have worked out some kind of licensing, which makes it a lot better for everyone. And so with that in mind, that's why now the key reasons why we're having this discussion now and everyone's getting excited, because number one is that there's all this infrastructure there that has taken years to come together. Like 4 years ago, no custodian in the world of security tokens. Now I could name like 10, right? And I'm sure there's more that I don't know about. So that was the first main reason. The second main reason was because this is all my thoughts as well, but it's because like last year, the DeFi meltdown and with all the blow-ups in decentralized finance and nowhere to get yield, right? So there's billions of dollars of stable coins because a lot of the crypto guys don't want to go into the banking system, the fiat system. So that's why there's hundreds of billions of dollars of stable coins and they're only earning their money. So then at the beginning of this year, there became the first tokenized treasury bills, tokenized money market instruments that were paying like 5% interest. So then this was the greatest yield in crypto. So all these crypto guys started buying real world asset tokens, which is tokenized T-bills, security tokens. So you've had both the TradFi guys that were always going to come, but you've also had the crypto guys who actually are buying them and now saying, oh, these don't suck anymore. Oh, this is actually a real use case. Oh, we can make money and hey, this is great. Let's do more stuff. So that's kind of why it's finally happening. And it couldn't have come sooner because it's been like 4 years of pain waiting for everyone to kind of get that's this point.
Julian, I was going to say, so what is the role that InvestorX plays in this entire journey then right now? What's the problem that you think that you're solving?
Yeah, so if you think about just what I just said, so token issuance leaves a lot of problems on the table. Security token exchange leaves a lot of problems on the table. Even security token broker only leaves problems on the table. So we said, all right, let's get all the licenses, let's stitch it all together, let's throw away, here's the 50 fee structures whilst we do all these things, because there is a justification, advising, structuring, listing, issuing, trading, because there's a justification for all these fees. But the world, these TradFi guys are pretty hopeless. Like, you need to simplify stuff for them. They're just not really going to get it. So we stitched it all together and we said, what people really want, and we've got 1,000 discussions and we've got a lot of people in our network. People want a low cost. They want a co-brand a section. They want to be in. They don't want any technical integration. Most of them don't care how the technology works. They don't want any new licenses, and they want to be able to issue, trade, and do everything. And liquidity was all in one place. And then I just topped it off by saying, and it's a low monthly subscription fee and all the batteries are included. So we give everyone the lowest possible price, the most flexibility, the least amount of work. And that's what InvestorX does. And then IXSwap provides the market making pools, which no one else has yet, but people are starting to finally understand that the AMM model is going to be the dominant for, I believe this, but now DBS, JP Morgan, they're all writing papers on it about the potential for it, even though we've built one. It's like this is going to be the dominating market making model for security tokens, because most security tokens are going to be private market assets that don't belong in an exchange anyway. So if you can let anyone start their own liquidity pool. We just did one last week. We did someone had a $50,000 share of a secondary, like a fintech company, and we started a $10,000 liquidity pool on IXSwap. Now, how much liquidity is there? Hardly anything. But the point is that, like, when have you ever been able to create liquidity for a secondary token and an ability for people to buy and sell it for $1? It's amazing. We need more capital and partners and all the fun stuff to grow, but yeah. So that's how we position ourselves in the ecosystem. The other thing I want to say is that, years ago, one of the reasons it took us a very long time to get some of our licenses, we have like 6 now, is because from day one, we were super pro public protocols, because that's where all the assets are issued. And a lot of other groups in the real world asset space, a lot of the groups you might have just heard of this year, don't have any licenses, and they better go get them or something's going to go down. But anyway, I'm supportive of all the crazy innovation and new platforms. But for the guys that do have licenses, that means they started years ago. Most of them went and built on their own private blockchain, because most of them were TradFi guys, and they know it's easy to get a license, because you just say to the regulator, how's all your tech work? And it's like, oh, it's fine. I can just delete it, and whatever you want me to say, I'll say it, right? Versus I'm going to issue these assets on these public protocols and have them. What happens if protocol fails? And a gas fee supporting terrorism, and all this ridiculous stuff. But anyway, we kept pushing on that, and big ups to Singapore government. That's why I'm still here. I mean, it's a great place, but like, we went to them and said, no, public protocols, like, it's not about private chains. It's no different. It's 5% better than the old version. Like, all the assets are on public chains, and all the innovations there, all the developers are there, all the brains trust is there, all the products are there. And we're just getting started on the products. Like in 2018, when we started in this particular focus, there were no NFTs. There were hardly any DAOs. I say hardly any, I think it was like 1 or 2, but it wasn't like a thing. There wasn't any market AMM models. And, which blockchain's proving, I said blockchain high level, it's proving that as a technology stack, we're just going to keep rolling out new things. It's going to be, which is exciting and it's great. But again, you can't do any of that if you're just sitting on your own little private chain. Even all the stable coins, right? Like all the stable coins are on public protocols, or the ones that matter, right? So that was key, because public, all the stuff we're talking about, all this value proposition that we're here today is, that's why, it's very much the Web3 DNA of the whole, the whole space. That's how we believe in it. And many people say, well, this isn't going to work. This is the wrong way. No one's going to issue an asset on it. And it's just, finally, that's not true. I think Franklin Templeton, CEO, they're like $1.5 trillion finance company. And even for people that hate TradFi for whatever reasons, the CEO was like, public chains are going to dominate, that they're going to overtake. No one's going to care about private chains, basically. And I was just like, yay, 5 years to get that validation. So anyways, but that's important, because I think that, that's where you should be looking to try things out, to get started, like start in the right space at least, and take it from there.
That's super interesting that you say that, right? Because I think this is one of those things that there's a group of people who've been touting this, like we should be going public, a lot of the case proof of work as well, blockchains, and there are a lot of detractors for a lot of different reasons about public blockchain being the infrastructure that we need. But I think it sounds like you agree with what we think is that is kind of that has the highest value proposition, that has the fundamentals that you need to make any of this worthwhile, right? To have peer-to-peer exchange, immutable data that you can do all this cool stuff on. So yeah, it's really refreshing to hear you say that. I don't know if did you have any take on that dichotomy and how and where we are now with it? Like, where do you think we'll continue in the future?
Yeah, so if you I can't recall exactly because there's so many things going on. I think it's EY or one of those big consultancies just did I've seen a few actually. Every year it's the same. It's like surveys on, call it TradFi institutions, basically who's using public and would you use public and who's using private. And it's just a steep kind of up curve for the adoption of public chains. And look, there's a world for private chains because there's a world of banks that aren't going to do anything and they talk a big game and they don't want to leave anyone. I'm not going to name names, but one of the biggest investment banks in the world, I went and pitched our whole concept and ideas years ago and they went, this is amazing. And I said, wow, let's get serious. There's no way in the world we're ever doing any of this. We're not letting our customers out. We want them stuck in deals. We want to take them for their fees. I mean, he was joking. He was saying it in a jokingly way, but he was also, haha, yeah, that's what we do. And I was like, wow. Okay. So anyway, I never started all this stuff to compete with banks or do anything with banks. If banks can use us and we can help them, great. But like there's two worlds going on. There's ABC Bank doing their own private chain, talking in all the conferences about how they love blockchain and all we're going to do stuff. And they're just a bank doing their own private, it's just a bank because we all know how they operate. Then there's a whole new world, like what we're doing, new assets, startups, the crypto exchanges, the grab financials. There's a whole new world. Like that's actually what you're seeing right now, which is not surprising at all, is banks are all adopting crypto and banks are now, and they always have, and there's a renewed push to screw crypto companies over by kicking them out of the bank so they don't have bank accounts. And bang, the bank pops out and they're doing all the same services and selling crypto and all that kind of stuff. So that's probably good overall price action, number of buyers, all that kind of stuff. And that's fine. But that's the world, right? It's like it's the banking system and then it's everyone out. And it's almost like the war that goes on and it's kind of fun. And it's not really like a friendly competition at all. It's like all out war. But, at the end of the day, we're not full crypto and we love crypto. IXSwap even has its own token. And we're right in the middle. So we got to kind of play nice with everyone. But at the end of the day, I think that, banks will help the real world asset industry. And eventually, once they're busy tokenizing their own boring bank assets, they'll get demand and they'll start looking for all the exciting alternatives and all these other stuffs that is being worked on out there. And even if they don't come, it doesn't even matter. Like there's a whole new world being built without them. And all the brains and all the finance people, they're all moving they have been for a long time. I mean, you guys are doing the same thing. I'm doing the same thing. I mean, this is where the action is. This is where the whole financial world's being kind of redesigned.
Exactly. It's quite exciting to see the momentum growing as well. So just to recap, to confirm my understanding, when we talk about tokenization, it's all about, representing ownership of an asset in a very efficient way. And that's effectively what InvestorX is doing. They're providing the tools for people to represent, which are, quite complicated objects, highly regulated assets in an efficient way, in a cost-effective way. And then the other part of that, if we can do that, represent that ownership in a very effective way, the next bit is the exchange. How can we actually exchange that ownership in the most efficient way? And, when we think about securities and bonds and all this kind of thing, it's quite heavily regulated. It's very manual. I imagine it's quite laborious. And that's where IXSwap comes in, right? You're trying to automate and make the process of actually exchanging those assets as efficient as possible. And when you say automated market makers, it's sort of like smart contracts is probably that's probably the buzzword I'd probably use, try and like recreate and reduce the number of steps involved by just automating processes based on predefined values. Is that correct?
Yeah, well, the simplest way to explain the difference between an AMM, an automated market maker, versus a traditional market maker is to start with the traditional market maker. And that's where you open up Binance exchange and you're buying BTC, USDC or whatever it is. And it's definitely not USDC, but it's BTC, USDT. And you see all the different prices, right? All the bids and all the offers. And there's market makers in there buying and selling and making the market. So that's their market making. And they can be big and small and whatever. They can use their own money, outside money. Some of them have license, some of them don't. That was the original global understanding of what an exchange is and how market makers work. And it's the same for Apple stocks on NASDAQ, right? Same thing. Assets change, different players, same thing. The automated market maker was an algorithmically driven development where there wasn't all these different bids and prices. It just priced an asset based off smart contracts and how many of those assets exist within a pool. So when you start a pool, there's different versions. I'll try and keep it simple. You bring your token A and token B that have equivalent value on day one, and then it starts trading, and that moves up and down, and then you have market forces. But when you go to buy and sell, just I want to buy token A, it just immediately calculates what the price is that second for you. And there's not like other prices, it's take it or leave it. And the difference as well is that the automated market making solution is crowdsourced market making. It doesn't have to be a company or one person, or it's anyone who has those tokens who's legally allowed to hold them can join the pool. So that's another key difference. You don't have crowdsourced market making from a traditional market maker.
Yeah.
that was part of the innovation as well. Because if you think about it, and why Uniswap became so successful, because first of all, these big market maker guys in the big exchanges, they don't want to deal with all the small stuff, right? They only want to do the big stuff. So it leaves the biggest side of the market, because there's a lot more small guys than big guys, with no help. And so when Uniswap said to everyone, you guys can start a liquidity pool yourselves, and it's small. And then once you do that, go and tell everyone else who bought your tokens or that you're trying to sell them to, yeah, there's some liquidity here. It's small, whatever, get involved, put your tokens in, we can buy and sell, we'll create that market. So they've given so much to the market. Like some of the now, I don't know the exact ones, but some of the biggest pairings, I don't know, Ethereum and USDT, whatever, they're deeper pools on Uniswap than they are on Binance and Coinbase. Yeah. So, because there's also a side of the crypto market that's so anti-centralized anything. There's a side of that refuses to, especially after the FTX debacle and all these exchanges stealing everyone's money. But they'd rather have the AMM model for buying and selling, which, there's times where you might get a better price on a centralized exchange for whatever reasons. They'd rather stay in decentralized land. And the other key point, at least on the crypto side of Uniswap, was you never gave your coins to anyone. That was a big part of it.
Yeah.
One slightly different because smart contracts alone can't legally custodize a security token. There's got to be a licensed player. So it's a slight change behind there.
No, that's great. That was great a description actually, because I think automated market makers, AMMs, are quite hard to describe actually if you're not having a bit of background in this. And I think that was a really nice way of doing it. I think it's also very Web3 in the sense that, as you said, it's a crowd-funded thing and it's very permissionless. Like anyone can come and join this pool of funds, and the larger the pool, essentially, the more stable that price should be, right? So it's similar to how Bitcoin works. Anyone can join as a miner. Anyone can pool their resources to help the network and secure the network. And then the bigger it gets, the more secure, in theory, it should get as well. So yeah, it makes sense that the innovation came out of the Bitcoin blockchain era.
That's one of the reasons I love IXSwap. I think it's kind of the killer application for the space, but also it's crypto born, right? That's where the innovation came from, and that's why all these maximalists kind of miss the point, because like some of the best things that happen in the space, whether you're a blockchain, a protocol maximalist, Bitcoin maximalist, whatever you're doing, some of the best stuff that happens is when there's a bit of this and a bit of that, and this is the way of doing things, and that's exactly what
hybrid.
Yeah, I mean, even in DeFi, decentralized finance, like up until lending, borrowing, staking capabilities in crypto, when that came a couple of years ago, the activity and the volume and the price went galactic. What is lending, borrowing, staking? They're banking services, right? Essentially, even if you don't like to hear that, that's what they are. It's just like, it's financial services. But then look, we brought that to crypto, and bang, that did a great thing. So yeah, now with this one, at least we're going back in the other way. And it's hilarious because you can say to people like, at the beginning, I saw every token, because at the beginning there weren't that many. I used to feed all the security tokens because, they weren't that many. They weren't very good. Actually, most of them were terrible. But I used to come along. The one part of the story wasn't that, but the real part of the story was every single issuer. I'd say 90% still today. And we probably have 10 to 20 discussions a day. This sounds great. I'll do it if you guarantee liquidity. It's like, what does that mean? They're like, well, sounds great. Like, so, guarantee me liquidity. I'm like, well, here's a little unfortunate news for you. There's no magical market maker that doesn't know you, sitting up in the sky, dying to make your asset that we don't even know what it is, and therefore will guarantee anything at all. However, that's what we used to say, and then just leave it there. The next part is, however, we now have a system where you can be the market maker, which of course, if they're not super crypto native, they could have crossed their eyes and have a bit of a brain fart and say like, what? And it's like, we've got this system where you can start first liquidity pool because no one else is going to do it. There's another side of this. Like, there's no one else is ever going to do it. So if you want to do it, you do it. And then they go, oh, how's this work? And then some of them start to really go, wow, okay, this is really interesting. And, away we go, try and get them started and set up and get them out there.
That's again a really good point. I think one of the things that I find quite refreshing is what I assume are your views on the regulation of digital assets, which probably weren't the views of people in the space maybe 10 years ago. Could you just give a bit more, maybe flesh to the bones on what you think the role of regulation is and should be going forward for digital assets?
So if I separate between crypto and real world asset tokens, the crypto is evolving but getting more clear in different jurisdictions around the world. There's a lot of stuff I completely disagree with, but I'm not writing those rules, and there's a way to play. That's how I look at it. So, and if you're a company in crypto, go somewhere that treats you the best, and that's as good as it's going to get, right? Unfortunately for American friends, they're getting absolutely pummeled, and I think that'll change. I bet that would change. But up until now, it's been extreme pain. They're leaving. They've got to leave and go somewhere else where they can run innovation and business. And even like Singapore has become like definitely number one hub in Asia for blockchain. And so many discussions I had at Token 2049 2 weeks ago was like, wow, it's pumping here. Like, it's great. In Asia, we also don't have like the US dollar to protect, and we're not like complicated in the EU. It's all these members and everyone, it's too many cooks in the kitchen, all that stuff. So on the digital asset and the crypto side, it's getting more clear. And, it is what it is. Like, there's ways to do it. And some people are retail only, some are accredited only, whatever the rules are. So that's good. And that's progressing. And, UAE is trying to now become the latest and greatest. And Hong Kong's turned on the tap after being years of like, we're not doing anything. On the real world asset side, the security token side, every country has their own securities regulations. What's interesting about security tokens is, and as I said before, you don't need new regulations. Now, there should be updates and there should be upgrades. And there's two ways to think about this as well. Most people are in a tokenized security world where there's a piece of paper, we're tokenizing a share. That piece of paper might be a Singapore fund vehicle. So, it's a digital representation. And then there's things going on there. So that's what a lot of the world's real world asset tokens are today, security tokens are today. And that'll go on forever, I think. And then there's the other side, there's in parallel, we have this, let's call it paperless based security tokens, which essentially are things like DAOs. Like a DAO is the very first security tokens because there's no paper. Challenge there has been no government in the world considers Ethereum to be a country. So, a lot of the DAOs have to back into companies. Otherwise, they start getting called illegal securities and all this kind of stuff.
Yeah.
So my point is that on the real world asset side, there's already enough rules in place. There's ways to do things. So it's really a matter of like, you got to go old school and get licenses or find licensed partners. And that's been our position since day one. And how I think about it's evolved over time. I used to be a bit more, everyone will want to take their security tokens and put them in their own ledgers and all the fun stuff. And that's going to be possible. The important part about that is, and then what do you do with it? And the answer is nothing. And security tokens are not like Bitcoin, right? You can't just come and steal someone's security token and then sell it somewhere else because it's not private key based. It's like attached to an asset based, and the asset needs to know who the owner is, and the owner needed to register because that's how the world works with equity. So if I steal your STO, it's like me stealing your piece of paper and it doesn't work. That's the simple version. So you don't have that problem. Okay, maybe the banks are coming and stealing people's cash, but no one's really thinking that the banks are coming and stealing your shares of your real estate yet, But so that's not really a problem that the world's thinking is coming today. But I think that, if you think through what I was saying at the beginning, which I believe in, the real value of tokenizing here is lending, borrowing, staking, plugging into an AMM, distributing on a different platform, Well, I don't want to deal with that on my ledger. Just like that's why people buy crypto on Binance, because they don't want to deal with anything, and they want all the services there, and they just want to click around, and hopefully you don't get your money stolen. And it's the same for interactive brokers, right? Like, what's the point of taking my Apple stocks off interactive brokers? Like, there is no point. Actually, I don't even own them there, right? No, most people don't even know. You don't even own your stocks. It looks nice. It's got a little, this is how many dollars I have each day, and it says that many stocks. I don't even really own them. But anyway, the point is that I trust the system enough and interactive brokers enough that I can leave them there and loan and margin and take it out and send my money back to whichever bank. And that's how I think security tokens are going to work. So although technically you can do things like send them peer-to-peer and all these kind of things, I just don't think let's think about one of the best statements I heard the other day was like, what was a discussion around the UX UI for Web3, Web 2.5, Web 2, which is a big discussion point. How does the whole thing work when you're using it? And it was like, we don't use those terms in our company. We just say, what do humans want? What do humans do? And build that. And so what do humans do with securities? What do humans do with crypto? There's a very small percentage of people that live on DEXs. Most people live on centralized exchange. Even after FTX, stole everyone's money, go to CoinGecko or CoinMarketCap and you look at the trading volume on the centralized exchanges, and it's just where it's super dominant force of nature. People still leave all their coins on exchanges. So that's what I think is interesting about security tokens. And even now we've learned that from our own platform, where we started off, it's MetaMask only. Everyone own your own, deal with it, take care of it. And then people sounds great, man. I'm not doing it. I don't want to touch any of this stuff. You did want me. It was like, what? That's from individuals to banks to everyone. You do it for me, so I don't want to touch it. And, it's just here's some money. I got a friend send me money. There's a pay now system here. It's like digital banks just send me money. I'm like, why'd you send me all this money? They're like, oh, can you buy that thing from me? And I send it back. No, I'm not dealing with it. What? That's not how it works. That's not the system. But the point is that that's how I think a lot of the marketplace will be in terms of where's the volume of users and just giving people what they want. And, of course, self-custody is possible and all that. But I think that there's a lot more scalability if you mirror more of what people are used to from a UX UI perspective.
Yeah, I really like that point. And I think me and Jack came to that realization maybe 6 or 7 episodes ago. We were so deep in the tech and so deep in the theory of Web3 that you were like, look at all these cool things, full empowerment, full peer-to-peer exchange, all this kind of your privacy security stuff. And you realize most people don't care. They care about the user experience. It's the same with ChatGPT. The reason that's taken off now and that's the buzzword is because of the user experience. The underlying tech maybe isn't that great compared with competitors. And I think that's something that all products in Web3 and all companies based around the principles of Web3 need to realize is that the fundamentals to a lot of people actually don't matter that much. They care about their day-to-day benefits and user experience. I'm really glad you made that point.
Well, yeah, we've had to, I'm not going to name platform or product, but we've actually had a discussion recently. I said, I know we built the best possible version of this. Let's just say version, not UX UI. Just are we using blockchain? There's no banks, there's no paper. This is just amazing. But because people have to do this, this, and this, and bridge that and go to that second layer protocol to let them buy it with Visa. And it's no. And I was like, all right, then they won't buy it. Right? Well, let them do a bank transfer. No, we can't have that. I'm like, okay, they won't buy it. So we've, even on one little project we were doing, it was painful because it is the best version of itself, but it's ahead of its time. It's got to come back and do some baby steps, which sucks, but is what it is, and then still have that there, still have the great version for the super degens and the guys that know what a bridge is and the guys that know how to do X, Y, Z. And then for everybody else, which is nearly everyone, can we just build something that they're used to clicking or in a payment method that they understand? Otherwise, it's not going to grow that fast. So everyone probably agreed, but yeah, it's interesting about that. And if you think about why, we've proven this in crypto, which is a good analogy because crypto's, the DNA of crypto was a new world of money and we own it and no one else can take it off me and it's self-custody. All right, so why is everyone trading on centralized crypto exchanges? oh, because it's easy. I don't know how to use the DEX. I don't want to deal with the MetaMask. I was like, so the value proposition's there, but 99% of people went, nah, UX. So we've got to build like that in this space. And even the hardcore Web3 platforms, I think, need to build more like that. Otherwise, they just assume that everyone knows what they know. And most of that knowledge for those founders, at least, or those product teams, is a couple of years in the weeds and losing coins and all the fun stuff, right? And that's why they know. Like, most other people don't have 3 years to work this stuff out, right?
Yeah, and that's why Web 2.5 is so important, because the techies think they know what the end goal is, but users are used to a certain way of thinking, a certain user experience, and you need to take them on that journey where you're making those little steps. And I think that's something that you do in InvestorX, obviously.
Yeah, and a lot of the big VCs won't say this out loud, but that's exactly what they've been doing, and they've been doing it for a long time. Yeah, they'll always promote and they are investing in Web3 and all that kind of stuff, but there's already been, the guys that have been deepest in the space investing for many, many years have also been in many projects already that were ahead of their time from a UX UI. They were ahead of their time from adoption. And therefore there's much more business. And, there's also in the last bull run, right? Like, oh, we're going to do a metaverse and it's going to have 75 million people and it's going to be the next Facebook in there. And it was just like, nah, that didn't happen. And like, it sounds great. But then again, like, what are you talking about from a UX UI? That's other than people clicking the Facebook button on their browser and staying in Web 2. Sure, you lost a few people from there. I mean, even Zuckerberg got excited by the idea and everyone was laughing at him still. But I mean, that'll evolve, but that was just another kind of point in case related to trying to make sure we don't get over the skis on the onboarding side.
Yeah.
You think about MetaMask is one of the reasons Ethereum still dominates. It's because of MetaMask and all the on-ramps and the rails. Like most of the other protocols so we've integrated with 5 public protocols and we're about to integrate with another 4. And 3 of those protocols, which I won't name today, there's nothing happening because their wallets are so complicated that our CTO couldn't work it out for an hour. It's like what's going on?
People lose the woods for the trees with this thing sometimes. I think you can really overcomplicate things and you can lose sight of the actual problem you were trying to solve for your customers in the first place. So and speaking of which, so you said about some of what you're doing being ahead of its time. What do you think the future does hold for tokenization in general? Are there any kind of major use cases that you think will be most exciting? And then what is in the future for InvestorX?
Yeah, I got asked this week actually, like which assets and which areas are pumping the most and where's the excitement, and of course a bit of talk about carbon credits and whatnot. We're asset agnostic and industry agnostic because for me, a tokenized share is a share of anything. So what you're seeing now is evidence that all different types of companies and industries are trying stuff. Like there's carbon credit tokens, there's uranium tokens, there's real estate, there's private equity startups, there's all kinds of stuff. And so I don't think about any industry going to be bigger or better than any other industry, because eventually I think that governments will stop issuing pieces of paper, and the only way you can set up a company will be on a distributed ledger, and then everything will be a security token, right? But so until we get to that point, everyone's having a crack and everyone's having a go. What I think is more important is for people to think about what I think is more exciting and interesting is all those other value propositions that I mentioned about what you can do with a tokenized security and an STO. If you can, because then there's the multi-dimensional value, and it doesn't have to, it could be anything, it could be real estate. So I think the most exciting place to build, and what I get up after, these crazy long days all the time, is like, that's where the magic is. To me, it was all very obvious that we tokenize shares because we've been digitizing everything. The move from analog to digital has been going for a long time, and email and paper and all that stuff. So it was just made a whole lot of sense. So that was the easy part to consider. And then now it was like, that's a given. So if that's a given, which is now starting to come to fruition, how do you start building these other things? And I even tried to get into the lending, borrowing, staking of security tokens like a year and a half ago, contacted all the big DeFi platforms, said, oh, we've got STOs and licenses, and like, we can't do STOs. I'm like, I know, that's what we have. You've got risk management and tech. Of course, they all had zero risk management. And when they did blow up, a lot of people were saying, well, okay, the blow up's terrible, but what it proved was this huge use case. So if we stop just lending tokens for other tokens and stay yield farming token for token on the same token and use real assets behind it, that's a massive use case. And that's what I was thinking. I was like, yeah, this is, again, that ICO, let's make it STOs, that lending, borrowing crypto, let's do that in STO land, that AMM model for crypto, let's do that with the real assets. And so that's where that's the exciting kind of, I guess, cyclical where it's kind of all going. But I think the most exciting part is building those new rails, right? That's just blue ocean territory. Like no one's, it's just new structures that come up with a brand new VC, tokenized VC fund that operates differently and has distributions and dividends. And that's the magic, I think. That's where I think the excitement's going to be moving forward.
Yeah, I totally see that. I can see, building the infrastructure for this hyper tokenized world is a huge opportunity. So Julian, it's been such a great episode. I've really enjoyed having you on. We've got 2 closing questions we like to ask all our guests at the end, because we like to see how the responses change and vary over time. So if you're happy, we're going to just throw these at you very quickly.
Sure.
So firstly, in one sentence, what is Web3 to you?
I would say that Web3 to me is the use of technology to develop communities that exchange value, that is run and organized and run by that community with no third party in charge, and how all these people exchange value and communicate. And it's all digital, it's all blockchain. That's how I kind of see it. That's a long sentence, but that's what I think.
No, that was one of the shorter ones, actually. And I think it's the first time someone's called out explicitly community in the answer, which is really interesting, because I think people don't understand how much of a community technology is sometimes. So yeah, that was a great answer. And my second question then is, so if you could pick anybody throughout history, so that means they can be alive with us today, or they can be, from any time in the past, that you can sit down with and discuss Web3 with, then who would you pick and why?
I'd probably pick Confucius, because I studied a lot of philosophy and I still listen to, call it readings or scripts, whatever, people that podcast this stuff. Alan Watts, he's one of my favorite guys. So I'd probably sit down with him and find out what he thinks about the world. That's probably my choice.
That's a good answer. I'm a big fan of Confucius too. So yeah, thank you for joining us, Julian. And thank you to those listening wherever you may be. And join us next time as we untangle a little more of Web3. Thanks for tuning in to another episode of Untangling Web3, produced by Emma Camilleri.
Don't forget to send us your thoughts, questions, and comments on social media. And be sure to follow us on your favorite podcast provider to catch the next episode. See you next time to untangle a little bit more of Web3.
The views we express here are our own and do not reflect the views of our employers.